a mortgage and a heloc. So I walked in the bank and I had $5,000. That was my down payment. And I walked out with a check for $15,000. That was my home equity line of credit. A lot of people don't understand how I did it, but I got a mortgage and then got a HELOC.
So a HELOC is what they call a home equity line of credit. So in that situation, we're going to look at how much you owe on that house versus how much is that house worth. The difference is what's called the equity. So if I have a house and I owe $50,000 in it, but that house is worth $100,000, I have $50,000 worth of equity in that house. I can then use that equity, basically, like he said, as a line of credit, as collateral to back a line of credit. So most financial institutions won't go up to 100%. So in that scenario, obviously it's a little bit jaded. So like if the house is worth 100 and I owe 50, I can't take out 50. Most financial institutions will maybe only let me go up to like 90%. So instead of taking out 50, I might only be able to take out 40,000. That's $40,000 in equity or a line of credit that I can draw off of based on me owning that house, right? So that's kind of what he did. He went in basically, he purchased the house. The house had enough equity already in it that he could get a line of credit and then draw off of that line of credit and walk out of there with more money than what he walked into that situation with.
With a home equity line of credit is actually a loan. So you have two payments after that. I have the mortgage payment where I'm paying the house, and I also have the loan payment.
Right.
So that's what I wanted to clarify for people. Like, this is a loan and you do have to pay it back.
Yeah.
So therefore, when you rent out the house, make sure it's making more than what your payments on both of those will be. So now you still have cash flow, but I don't have nothing in the deal. I had $5,000 at first. I got that back plus extras, and now the tenant is paying off the house for me. So that's a tactic that I use that most banks will let you do.
Right.
If all of your ducks is in a row, your credit, your job history, and the property is up to par on it.
Absolutely. I like to describe it as it's almost like having a credit card with your house as collateral, right? Because in that example that I gave, you drew the $40,000. If you draw that $40,000 out and then you pay that $40,000 off, you can spend that $40,000 again, right? Like you can reuse that line of credit over and over and over again as long as you're paying it off, right?